What's going on, everyone? Charlie here. We're going to take a look now at reporting of securities loans, Rule 10C-1, Part 2. We're going to look at the market structure and a little bit of background behind securities lending in that regard. Let's go and take a look. So, background, market structure. Securities lending is the market practice by which securities are transferred temporarily from one party, a securities lender, to another, a securities borrower, for a fee, of course. A securities loan is typically a fully collateralized transaction. Securities lenders, referred to as beneficial owners, are generally large institutional investors, including investment companies, central banks, sovereign wealth funds, pension funds, endowments, and insurance companies. If you go through AMC and GME's 13Fs, what do you see? A lot of these things. Beneficial owners of large, static, undeveloped, or unleveraged portfolios, mainly pension funds, those of you YouTubers who keep hyping pension funds, increasingly cite securities lending as an important income-enhancing strategy with minimal or at least controlled risk. This incremental income not only helps define benefit pension funds to generate income, but also provides investment company investors with additional returns. Broker-dealers are the primary borrowers of securities. They borrow for their market-making activities or on behalf of their customers. Broker-dealers who borrow securities typically relend those securities or use the securities to cover fails to deliver or short sales arising from proprietary or customer transactions. While the identities of the ultimate securities borrowers are usually unknown, anecdotally, hedge funds rank among the largest securities borrowers and access the lending market mainly through their prime brokers. Brokers and dealers may also lend securities that are owned by the broker or dealer, customer securities that have not been fully paid for, i.e. have been purchased with a margin loan from the broker-dealer. As in, if you're in cash account, they cannot lend your shares. Oh my God. And the securities of customers who have agreed to participate in a fully paid securities lending program offered by their broker-dealer, like Weeble's security lending program that we all opted out of earlier this year. Now, securities lending transactions are usually facilitated by a third party. Custodian banks have traditionally been the primary lending agent or intermediary and lend securities on behalf of their custodial clients for a fee. Advances in technology and operational efficiency have made it easier to separate securities lending services from custody services. Such developments have given the rise to specialist third-party agent lenders who have established themselves as an alternative to the custodial banks. Agent lenders provide potential borrowers with the inventory of securities available for lending on a daily basis. I don't know if you remember this, but in April 26th of this year, right around when the repo market started taking off in demand, Fidelity became an agent lender. Now, in addition to agent intermediaries, there are also principal intermediaries such as prime brokers, securities dealers, and specialist intermediaries. The role of the principal intermediary is to provide credit transformation for lending clients who are not willing to assume exposure to certain types of borrowers. For example, a prime broker assumes credit exposure to the borrower. In short, agent intermediaries aggregate supply on lendable assets, while principal intermediaries aggregate demand for lendable assets. Some large investment companies and their fund managers have created their own securities lending programs and use their own employees to staff the program rather than using the services of a custodial bank, lending desk, or third-party agent lender. So you can see just how convoluted this industry is. It's awful. Traditionally, securities lending and borrowing transactions have been conducted on a bilateral basis. Generally, when an end investor wishes to borrow securities and its broker-dealer does not have those securities available in its own inventory or through customer margin account to loan, the broker-dealer will borrow the securities from a lending agent with whom it has a relationship, like Fidelity. The broker-dealer will then re-lend the securities to its customers, and loans from the lending programs to broker-dealers occur in what is referred to as the wholesale market, while loans from a broker-dealer to the end borrower occur in what is referred to as the retail market. Obtaining a securities loan often involves an extensive search for counterparties by broker-dealers. Now, Supernote 38 bilateral basis means typically the parties enter into a written contract that sets out their legal rights and obligations without central clearing. There are also digital platforms for secured financing transactions, which we're waiting from the NSCC, including securities lending, which provide electronic trading in the securities lending market. Another approach to securities lending is based on a competitive blind auction to determine the optimal lending strategy for beneficial owners who opt to use the auction route. The auction process is intended to improve price transparency for borrowers who pay for access to lendable assets. There are also efforts to develop and expand peer-to-peer lending platforms involving multiple beneficial owners and borrowers, where securities lending transactions take place without the use of traditional intermediaries. Additionally, the Options Clearing Corporation, or OCC, has two stock loan programs: the Stock Loan Program, formerly Hedge, and the Market Loan Program. The Stock Loan Program allows OCC clearing members to use borrowed and loaned securities to reduce OCC margin requirements, which OCC considers as reflecting the real risks of their intermarket hedged positions. In this program, OCC serves as a principal counterparty by becoming the lender to the borrower and the borrower to the lender for each transaction, much like what we see with the Fed in the current repo from the New York Fed. In its market loan program, OCC processes and maintains stock loan positions that have originated through a loan market. OCC acts as central counterparty to these matched loans and provides clearing and settlement services to the market and OCC clearing members. Securities loans may be either for a specific term or open-ended with no fixed maturity date. The typical market practice is for security loans to be open-ended, allowing the securities on loan to be recalled by the beneficial owner. The open recall feature of a securities loan is driven by the assumption that participation in securities lending should not impact the investment strategy of the lender. For example, a security may be recalled when its beneficial owner would like to sell it or exercise its voting rights. Loans that provide the borrower with certainty regarding the length of the loan can be more valuable to the borrower. In the United States, the most common form of collateral for equity security loans is, you guessed it, cash. The borrower of the security typically deposits 102% or 105% of the current value of the asset being loaned as collateral. The extra, which they don't bring up here, is called your haircut. The lender then reinvests this collateral, usually in low-risk interest-bearing securities, and then rebates a portion of the interest earned back to the borrower. The difference between the interest earned and what is rebated to the borrower is the lending fee earned by the lender. The portion of the interest earned on the reinvested collateral that is returned to the borrower is called the rebate rate, and it is the guaranteed amount set forth in the terms of the loan. It is possible for the lender to lose money on the loan if the interest earned on the reinvestment of the collateral does not exceed the rebates rate. If the security is in high demand in the borrowing market, the rebate rate may be negative, indicating that the borrower does not receive any rebate and must also provide additional compensation to the lender. When collateral for a security loan is in the form of other securities, the borrower pays the lender a set fee. The fee depends on the availability of the security being borrowed. Securities in high demand command a higher fee. While a security is on loan, the borrower receives any dividends, interest payments, and in the case of equity security loans, holds the voting rights associated with the shares. Usually the terms of the loan stipulate that dividends and interest payments must be passed back to the beneficial owner in the form of substitute payments. Now we're going to look into transaction reporting. As discussed above, certain institutional owners, including pension funds, which provide retirement benefits, and mutual funds, which retail and institutional investors rely on to meet financial needs, lend out their securities to earn incremental income, help pension funds generate income, and provide additional returns for their long-term savers. As discussed below, the existing data are not comprehensive or centralized, and there are significant information asymmetries between market participants. The transaction information that would be provided to an RNSA under proposed Rule 10C-1 would include securities lending transaction information from all lenders, and most of the information would be made publicly available. The Commission preliminarily believes that the proposed rule would provide material, granular, and timely data regarding the terms of securities lending transactions, thereby allowing market participants, the public, and regulators to access to key market information. Data available from private vendors. Currently, the predominant sources of pricing information for securities loans are private vendors who offer a variety of systems for borrowers and lenders of a security to provide and receive information regarding securities lending transactions. Some, if not all, of the private vendors operate their systems on a give-to-get model, which effectively precludes access to their systems unless the would-be subscriber has securities lending transaction information to provide. Some private securities lending data vendors provide an intraday data feed or end-of-day information on securities lending transactions by various market participants, as well as analytic services involving such data. The data are collected from securities lending transaction participants, including beneficial owners, broker-dealers, agent lenders, and custodians. Commonly, collected data elements include CUSIP identifiers for securities on loan, quantity, borrowing cost, utilization of available supply, owner domicile, and type of collateral held. However, the available data are incomplete as private vendors do not have access to pricing information that reflects all transactions. This, in part, reflects the voluntary submission of transaction information by subscribers to vendors and is compounded by the unknown comparability of data due to, among other things, the variability of the transaction terms disseminated as well as how those terms are defined. As no single vendor has information for all securities lending transactions that take place, some persons pay to subscribe to multiple vendor systems in order to capture as much of the currently available data as they determine to purchase, which can be expensive. Well, when you don't provide it to the public, what other options do we have? Jeez Louise, man. End of part 2. Next time we actually get into the changes of the rules.